oh, you guys are talking about the regional banks versus JP Morgan and stuff, saying it's not the same. But what about Credit Suisse? What about what's happening to them? Aren't they a financial institution that was considered too big to fail? And isn't it the same? Now, I would say Credit Suisse is a whole nother ball game where the last nail in the coffin was these bank collapses, these regional bank collapses.
Hi, I'm Nadia.
And I'm Nicole, and we are the Wealth Twins. Now, if you don't know, we teach people about how to manage their personal finance and also how to invest in the stock market. But today we're going a little differently, and we're actually doing our discussion behind the scenes that we normally have. We're going to actually give you a sneak peek as to what we do when it comes to discussing our game plan when it comes to the stock market, and also the research that we're doing in terms of trying to understand bank collapses, the Fed meeting, and just finances in general. So we thought you enjoyed this type of video today.
Yeah, our reason for this video is that we feel like a lot of people are fearful of investing in the market or keeping their money in the banks right now. And we really think there's no reason for you to feel that way. So we're making this video in order to help you make that decision on your own. So hopefully this helps. So let's jump into it, Nicole.
Okay, so I think the first thing we need to talk about is basically the recent bank collapses in general and how they compare to 2008. So I want to say first things first, Nadia and I both believe this is not a repeat of 2008. Now, who knows? We might be wrong in the future, but as of now, the information that we have, we do not believe there's a repeat. This is a repeat of 2008, and it's mainly based on a couple of different factors. One, the types of banks involved. Right now, what's going on with the bank collapses are mainly regional banks like SVB, and when it came to 2008, those were international financial institutions who could affect the whole world economy. So we're talking about different types of banks and different types of money. Two, I would say the reason why those collapses happen. As of now, we know that the bank collapses that happened recently are more due to like fear of depositors' money and also rising interest rates and just bad bets when it came to buying long-term bonds. So it's a liquidity problem. But in 2008, the main reasons why that crisis happened really stemmed from the subprime mortgage lending practices.
And the fact that a lot of banks didn't have the capital on hand to cover those bad bets that they did with the subprime mortgages. I will also add that the banks that are collapsing right now or having a lot of difficulty, like SVB, Signature, or First Republic, they had a very specific clientele. Those clienteles, they focused on businesses and like specific businesses, like these venture capital funds or very wealthy clients. They don't have the type of diversification when it comes to their client base than the bigger banks do. So you're looking at Bank of America, Citibank, Chase. These are big banks that have a wide range of customers. So when you have customers running on the money like these small banks have, that is a particular customer who is looking to move their money out of that and move that money into another place. Another reason why these banks had a run on their money is because these customers knew that the FDIC does not insure money over $250,000 in your account. These wealthy individuals had more than $250,000 in their account, so they did have to make a run on the bank to get their deposits out and put them into other accounts like money market accounts because they knew over $250,000 was not going to be insured. That turned out to be a different case because FDIC, or the Fed stepped in and said, you know what, we're going to protect all of the money. We'll give them dollar for dollar for the money they had deposited in these banks. And we're going to make sure we insure that, which should have instilled more confidence in the US banking system. But instead, panic and fear are still existing right now.
Now, I think what a lot of people need to understand, based on the news that we're reading, people like to call what the Fed did a bailout, what's going on with these regional banks, but I don't consider it a bailout. What Nadia just said is that the Fed has decided to insure all depositors' money. Now, they did that because of fear of the actual public who thinks that this is the same as 2008. And on the surface, they look the same, but they're not if you go deeper, right? The Fed had to stop that fear because it would have turned into a vicious cycle. If people see depositors taking money out of SVB and just in general out of banks, they might say, oh my gosh, my bank might be next. Let me take money out of my bank. But what's actually happening here is that these customers who had a large amount of money, higher than the $250,000, are actually moving their money into the larger banks that have more operations where they can use the money in different ways to get the liquidity for their money, but also some interest on their money. It's not the same as having troubles with banks in general. These
Mhm.
people are not taking their monies out of all banks. They're transferring their money from one type of bank to another type of bank because they believe those banks are safer for their money. Now, on top of that, again, 2008 versus now, there are different types of banks. And since 2008, the larger banks like JP Morgan, and Citibank, Dodd-Frank, the rules that were put in place because of the bailout that happened, have made it harder for these banks to fall victim to, failing. They have stricter rules now. Those rules were not really in place for these regional banks. So again, it's not the same thing. And the reason why the Fed stepped in was actually to calm irrational fears as to what's going on in the banking system.
Yeah, I think like you have to look at it. There's tier one banks and tier two banks. The tier one banks are the banks that are too big to fail because they will have a horrible feedback through the whole US economy if they do fail. So they have stricter registration, like stricter regulations on
Regulation,
them.
yeah.
The watchdogs are looking at them more often. They have to have more capital reserves on hand and they have stress tests. When you look at these smaller banks that fall into tier two, these regional banks, they do have some Dodd-Frank of the Dodd-Frank Act that regulations that are imposed on them, but they rolled them back a couple of years ago because they said, look, it's so hard for these smaller banks in order to be able to be compliant to the Dodd-Frank rule. So let's roll it back so we make it easier for them to actually run their business. But that could have been a problem. Now, these banks didn't suffer from maybe not having enough capital on hand to be able to cover these depositors. But what happened was that they got caught in the middle with these interest rate fluctuations and people running on the bank and saying, give me my money back. And they lost money this way. They
Yeah,
also had,
if you guys really want to go in, we did 2 videos when we discussed what happened with SVB and
exactly.
also what's going on with First Republic Bank. And we're going to keep it high level here, but if you really want to know what happened with those banks, check the links below in the description box, or we'll also have the links to those videos at the end of this one.
Yeah, just to summarize it, it's more of the type of clients they had, the fear among those clients, and then the type of securities they had on hand to be able to have as collateral. Okay. It's very specific. It wasn't enough risk management going around, but it's not like they were being wild west out here too. It had nothing to do with the whole overall US economy or the
Yeah,
US banking system.
they were buying US bonds instead of
Yeah, they
mortgage-backed
weren't out here
securities and
buying
creating
subprime
derivatives.
loans.
Yeah, now with that though, I don't want to paint everything all roses and pink either. Now,
Yep.
with that, I believe there's 2 issues that I still see happening. One, the lack of oversight, because along with the Fed giving these banks money, or sorry, the depositors insuring their deposits, you have to understand one of the functions of the Fed is not only to raise rates, they're also supposed to be the regulators of banks. Now, maybe they have their focus too much on the big banks and they're not regulating the smaller banks as much as they should. Because if they were, they would have probably noticed some of these risk management problems earlier, and that could have prevented some of these issues from happening if it was more oversight from the Fed. So I think that's still an issue, that there should be some more, regulations or oversight from the Fed. And I also see another issue with the fact that people are moving their money into these larger financial institutions, because if those financial institutions were considered too big to fail in 2008, and these smaller banks are now collapsing, these banks, these JP Morgans, so are only going to get bigger. So when is it going to be a point when they're not going to be too big to fail? If something happens to these banks, we
Well,
will
I would
find
say
ourselves.
the Fed, well, I can tell you right now, the regional banks who have not been caught up in this thing, I guarantee you every manager, every managing director, every partner at these banks went down and said, everybody, look at what we have on the books, look at what we have as deposits, and make sure we're not the next name that comes up in the news. But
Mhm.
also at the same time, the Fed is also worried about inflation. Okay. So the Fed, I don't know. I wouldn't say like their oversight of these small regional banks dropped down, but the Fed's main role right now is try to control the inflation that the US is having. And that's the same role that a lot of central banks around the world are focusing on right now because of a lot of things that happened during the COVID pandemic, the monetary policy
The
changes that happened,
quantitative easing, yeah.
and they have to start focusing on fighting inflation because we're getting hit with inflation right now.
Okay, now with that, I know some people might say, oh, you guys are talking about the regional banks versus JP Morgan and stuff, saying it's not the same. But what about Credit Suisse? What about what's happening to them? Aren't they a financial institution that was considered too big to fail? And isn't it the same? Now, I would say Credit Suisse is a whole nother ball game where the last nail in the coffin was these bank collapses, these regional bank collapses, because they lost the confidence of their shareholders and the confidence of their depositors. But Credit Suisse has been going through issues for years. And
Yeah.
one of the biggest things that happened most recently actually took place, I want to say 2021 or 2022, where they missed a margin call. They poor risk management again. Archelago's, I want to say that's the name of the hedge fund, basically, actually had a margin call that was never called by Credit Suisse. And it ended up costing Credit Suisse over $4 billion. And they were unable to get those assets back from that fund way later than all the other investment banks. So that right there was a huge problem with them. And it showed that one part of the bank wasn't talking to another, and that it was just bad risk management all throughout that bank. So it's not the same as 2008, because actually Credit Suisse did not get bailed out in 2008. And two, it's not the same as the regional banks. It's just that they just were just bad in general.
They had
Okay.
a series of events that eroded the investor confidence in them, and their major investors backed out and said, look, we're not giving you any more money. And that just kept eroding the confidence. And there was a lot of change that was happening in
Yeah, they couldn't
transitions
find a
within
good
Credit
head of the
Suisse.
company. Yeah.
It was just a lot going on. And you know what? The government forced UBS to buy them and said, look, we got to stop this because this is going to cause a ripple effect throughout the whole economy and global economy. So let's stop this right now.
Now, I want to move on to the Fed. Now, a lot of people just call the Fed and they make it a short name, and they oversimplify what this agency does. Now, the Fed is actually short for Federal Reserve System, okay, and it has a bunch of different functions. One being the U.S. Central Bank. That is the bank that runs the monetary policy and is responsible for the financial stability of the whole U.S. Okay. Now, one of the ways it does it is by two, is actually a dual mandate. One, they have to make sure that they keep inflation in check. And two, they have to make sure that they have enough employment. So maximum employment without high inflation. That's the dual mandate when it comes to the Federal Reserve System. Now, another part of the system is as a bank regulator, like we mentioned earlier. So we already spoke about how as bank regulator, they put some controls in place at banks, and they also decided to help help the depositors of these regional banks. Now, when it comes to them helping to stem inflation and also maximize employment, this leads up to what's going on today. The Fed is having a meeting, and they're discussing, should they raise interest rates more than they have? Should they continue raising interest rates? And this is what everyone is talking about today, and what some people have said the reason was for these banks collapsing. So now, do you want to speak about that?
Well, before a couple of weeks ago, they were set to start being more aggressive with raising interest rates because they want to get to, I guess, the 5.5 interest rate to start curbing inflation. And with the rates in the past, they saw that inflation has not been slowing down, so they need to be more aggressive when it comes to raising the rates. With all this has happened in the last couple of weeks, they're like, look, instead of us giving a 50 basis point increase, now the conversation is like, maybe they'll do 25% or none at all. Now there's different sides to that.
Not 25%, but 25 basis
25 basis point. So what people are saying, if the Fed says, you know what, we're not going to do a rate increase at all, that's signaling that there's maybe this banking situation is a bigger problem than we know about, and it will put a lot less confidence in the U.S. system right now and put worry throughout the economy. The Fed needs to focus on fighting and keep fighting inflation, because that is the bigger problem that's facing the economy now. And the U.S. we don't work in just a bubble. Inflation is hitting around the world. So you have the other central banks around the world saying, look, we have to keep raising rates in order to fight inflation because it's going to be a bigger problem. So if the U.S. pulls back right now and says, look, we're not raising the rate, that's just reflecting what's happening this week. but it's also going to have a longer term effect because we have to start raising rates in order to combat inflation because it's still not under control.
So I want to break things down for everyone. Again, this is not a very simple subject as to what the Fed does, how inflation happens, but let's just break down certain things. Now, we had mentioned the term before called quantitative easing. That is one of the tools the Federal Reserve uses to keep money flowing into the economy. So, how did that look for us? During the pandemic, the Fed put out a lot of money. They printed money, they actually lent out, and they lowered the rates, interest rates. When the Fed does that, it gives companies and individuals the ability to spend money more freely. It's easier for
And
you to
borrow
get
money.
credit. It's easier for you to borrow money. And lower interest rates does not incentivize you to actually save your money. It incentivizes you to actually spend. Okay. And they did that because they felt like the economy was going to shut down because of the pandemic, something that was unprecedented. So they had to put an unprecedented amount of money out there and provide a bunch of loans to different businesses because so many businesses were saying, we can't get loans, we can't get credit. And if they did that, the whole economy basically could stop. So what the Fed did, because they have that mandate of making sure that the financial economy is stable, they had to start putting money into the system. And one way is to either put out money or lower rates. Now, when you do that and you pump so much money in the system, inflation can happen, right? That means that the price of your dollar has lost, the value of your dollar has lost some buying power. Now, because of that, and everyone knew this was going to happen, the Fed has decided we have to start increasing rates. Now, what happens when you increase rates? It gives people an incentive to start saving their money rather than spending. It gives people the incentive to stop going out for loans because it becomes harder to get a loan. And two, the loan prices become they become more expensive. So the same people who were getting like a home loan at 1%, 2% a year ago, those same home loans are now 6% or higher, right?
7%.
Now, the reason why they're doing it because they want to cool down the economy. Too many people are spending too much money. It's too many dollars in circulation. You got to get some of these dollars out of circulation. Now, before this whole banking crisis happened, the reports they were using were some like, housing buys or things like that. And February, people were still buying more houses. The housing market has not cooled, even though the borrowing rate for a mortgage has increased. So they have to take that into account, not just one or two off regional banks who have decided to play a bad risk management game and the fear of a certain sector, the VC and the tech industry. They have to think about the economy in general and localize what happened with the regional banks. That's their own problem, and focus on the economy in general. So if they don't focus on rising interest rates to curb the amount of home buyers there are, to curb the amount of credit that's out there,
To curb the
to
price increases in goods.
exactly. If they don't do that, inflation is going to continue to rise and we're going to find ourselves in a very difficult situation. Now, if they don't raise these rates, everyone's going to think it's because of what happened with the bank collapses. And they're going to say the Fed, as a bank regulator, knows more about what's going on the balance sheets of these banks than they're letting on. It must be a bigger problem because another function of the Fed is to be the lender of last resort. If you cannot get money any other places between these different banks or so, they go to the Fed window or they go to the Fed to get money from the Fed.
Well, not just anyone. Banks go to
Banks, I mean.
the Fed window or the new facility they set up, which is the bank term funding, I think, program.
Yeah. So with that, the bank knows what's going on in different markets more so than we know. And if they don't raise these rates, it's going to signal to the market who's already priced in that regional bank problem was just an isolated incident. Maybe one or two things more might happen, but they've already priced it into the market. And you can see probably the stock market has been up the last 2 days. So they're acting as if like this whole banking thing didn't even happen. But it will, whatever happens with the Fed today is going to dictate what goes on later on.
Yep.
Now,
Now, let's jump into, should people be fearful of what's going on? I think When it comes to putting your money in the bank, I don't think you have to be fearful. The average American does not put more than $250,000 in their bank account. Okay. So I think the news needs to do a better job of explaining to people you don't have to worry about your money in the bank because the government, well, the FDIC insures 250,000 and below. So this does not affect the average American. You don't have to worry about it. Your money is safe in the bank. Now, should you be investing? I see nothing wrong with investing right now. If you think that prices are low right now, maybe you should look at it as a sale. And these companies that are just getting hit with consumer confidence and what's going on and the overall sentiment about people being fearful of investing or putting their money in the bank, maybe you see this as an opportunity to buy shares in these banks because they're not getting affected by anything other than, hey, rumors about, oh, people are scared. Fundamentally, these banks should be strong. So I think, like just what my father used to say, scared money doesn't make any money, but you shouldn't be silly with your money also. So don't stay out of the market if you're looking to make money, but don't take risks that are unnecessary at this moment too. Be a little cautious, but don't just not invest or put your money in the bank because you will create the situation that you're actually trying to avoid.
I mean, for me, I think the first thing you need to understand, what are you fearful of?
Mhm.
Because that dictates what the strategy should be. Are you fearful of a recession? Are you fearful that the US is going to collapse? Are you fearful that the whole banking sector is
Industry.
going to go away? You have to think about what exactly are you scared of happening? Because if you're scared of a recession can happen at any time. People have been talking about recession for the last, 3, 4 years. Okay. No one can time a recession. Now, if you're fearful that your money is not going to be safe in the bank, like Nadia said, if you have less than 250,000, don't worry about that. Do you believe in the US economy, right? If you believe in the US economy, then maybe you should look into the stock market, because one thing I don't like with all this fear mongering is they're not telling people what to be fearful of, or they're lumping all fear into one basket.
Mhm.
And two, what I don't like is that, when it comes to whole is fear, they're making things too simple, and it's not that simple. All right, you have to understand what your situation is, and you have to understand that there are controls in place like the Fed to stop the US economy from going down. And it's pretty naive to extrapolate what's going on with these regional banks to say this is what's going on with the stock market in general. I would say, for me and Nadia, I guess I would speak for Nadia in this case too, we do not try to predict the stock market. Okay, if
The
you
only thing you
believe
can price in is that something's always going to happen. Either you're
exactly,
going to benefit from something's going to go up all the time, or you're going to have some kind of event that we have never had before. That's the only
exactly.
thing you can guarantee.
You cannot say because of this happened, now the stock market is going to look like this. That is naive. And on top of that, it's not understanding that the whole rule that the market is efficient.
Yeah.
All the prices that you see for stocks, people who are academics or that study the market would tell you that the markets are efficient, which means that people who analyze individual companies have already put any type of shock or any type of contingency or risk into the price of that stock. So that stock reflects all the fears, all the, you know,
I would say over the long term, yes, not in the short term, because you don't know what people's intentions are
well,
with
that's just
information.
irrational in terms of people's emotions are irrational a lot of times. But when you look at a stock price overall basis, all those things are priced into the price of the stock. That's just what the efficient market is. Now there's some, companies that are going to get adversely affected and their stock can go up or down. And those are some that people say, well, these are value stocks now. You see, and that's how they come in and they get a good stock under the radar because they said fundamentally this stock is a great stock. It's getting unfairly punished because of what's going on in the news.
Yeah.
But I don't see how what's going on with SVB has anything to do with Apple, who has a ton of cash reserves, who has probably a better risk management than what was going on SVB, who's able to make money based on innovative products and not just based on getting deposits from customers.
Yeah.
I
My
don't
thing
think
is,
you can extrapolate, you can connect these two like that easily.
I think when you look at investing, you know there's risk inherent in investing, but it's how much risk you're willing to take on. If you're being honest with yourself, you don't want to take a lot of risk on, then don't invest as much or invest in safer securities. But you can't say, I want to invest and there's no risk. You have to understand this is part of the cycle of a market. It goes up, it goes down. There's recessions, there's bull markets, there's bear markets. It's part of the game. But
Yeah.
if you want to be in the game, this is something you have to accept. Me,
N-
my own personal risk management process is that I say, huh, this is what the bare minimum I'm willing to lose, and then I'll work from there. So be honest with yourself and say, look, this is what this is what I'm willing to deal with, and this is the amount of risk I'm going to take, and I'll act accordingly.
Okay, so in general, we've given you now, Nadia and I are not experts by any means in terms of all this stuff. We're reporting to you what we're reading, what we're understanding, and we're trying to give you a viewpoint that's not fear based, but more of analytical side of things, right? Now, I think the next best thing is Nadia's already started doing is to tell you what we're doing. Now, I said before, you have to understand what your fear is, and then I will dictate your strategy. Now, for me, I don't believe the US economy is going anywhere. I don't think it's collapsing. Okay. If it does, we got much bigger problems than,
Yeah.
than a
Worry
lot of
about where
people
we're
would
going to
think.
invest.
Okay. And if you're really fearing that the US is just going away and the dollar is just horrible, that's how Bitcoin goes up. That's how gold prices go up, right?
I think the article I read yesterday that half of the world is going to suffer water scarcity by 2025. It's a bigger fear than whatever happened in an economy.
Okay, so I don't believe that the US economy is going to go down. I believe there's a lot of great businesses here that are doing great business and they can survive a lot of recessions. On top of that, Nadia and I, so really the main fear is how do we act accordingly if my fear is a recession? And I think with that mindset of what's fair, I think it goes back to the basics. Nadia and I have been through a couple of recessions, and I think we're just going to continue to do what we've always done. We live
Long-term
below our
investing.
means. We don't try to, time the market or beat the market because we're not going to say we're better than all these people who actually get paid to analyze the market on a day-to-day basis. So we don't try to beat the market. And we also try to pay down our debt. You want to be conservative and you want to have cash on hand so that you could take advantage of the opportunity. A recession does not affect everyone the same way. A teacher that goes through a recession is not the same as an office worker that goes through a recession. It's much less likely that a teacher is going to get laid off than an office worker. So that recession is going to affect that person differently than another. Just like if you're afraid when it comes to emergency funds, if you're in an industry where you can get a new job very, very quickly, it might not be necessary for you to have 6 to 9 months of emergency expenses. But if you're in an industry where it's very hard or you're very high in your position, and it might take you a year or two to get another job with equivalent of pay, you're going to need more in terms of savings.
You have to be more conservative.
Yeah, so it all comes back to your personal situation, what you're afraid of, and what you think is going. How can you best protect yourself? And really, is going back to the basics and what has served us in the past. That's all we're doing. We're not changing our game plan because our main fear, I would say, Nadia, I'm not going to speak for you, but my main fear is if a recession is going to happen, how is it going to affect me? Okay. I'm not dealing with if the US is going to tumble, what should I do? Okay. These Bitcoin maximists, and I will be honest with you, I do have, other assets, but I'm not a Bitcoin maximist that thinks that, oh my gosh, these bank collapses are saying that this is the same thing as 2008. Let's buy Bitcoin. That is nowhere near the way I think. Okay. And you'll see that right now, I bet you Bitcoin is up and gold is up. And they're going to be up until the Fed makes this meeting. And I wouldn't be surprised if the Fed raised rates that Bitcoin
I think the
prices.
Fed is going to raise it 25
Nadia,
basis
you went out, so let's see real quick. But, other than general, I think we both think that the Fed is going to raise rates. I'll be very surprised if they don't. But again, we're not sure, right? We're going through this the
We're
first
all
time, just
going
like
through
you
it at the
guys.
same time. I think everybody understands. No one knows what's going on because no one has experienced this before. But what you can do is make sure yourself is covered. Don't take any unnecessary risks and just say, this is part of the process. This is
Yeah,
what happens.
whatever happens, it's never a good time to panic.
Yep.
Period. Okay. I think if you can get this whole thing discussion, one, do your own research, go to different sources, realize what's going on, and don't come from a fair place of fear. Two, is never a good time to panic and make a plan that's going to help you get a strategy that really is going to affect you and you personally. Okay. And it puts you in a better place than you, if anything did happen. And
And
if nothing
Nicole,
happens, living below your means, getting low your on your debts, and also playing it safer when it comes to just not trying to time the market will always serve you well. Because if something happens, you're good. If nothing happens, you're also able to take advantage of different opportunities. So I think
exactly.
that's where we are today,
So Nicole,
right?
I think you should tell them about our wealth pack.
Yeah, so if you guys enjoyed this type of video, one, I would like to see if you guys give us a like, because we would like to know if you like these types of videos. And then two, if you enjoy this type of analysis where we're not get rich quick scheme type of people, we're also not fear mongers. We try to be the adults in the room, tell you what we're learning, and try to, put frame it in a way there where you're
It's
just trying to be
understandable.
rational,
Yep.
with your decision making. If you like that type of content, please consider joining our community that we have, our private community called the Wealth Pack. You will see the link below. It's our email newsletter where we share these types of thoughts and our insights with our private community. So if that's something you would like to learn more about and actually join, please use the link below. Other than that, I wish you guys a great day. And thank you,
And
Nadia,
we
for
do
talking to
we
us.
also have courses too. If you want to learn how we invest and learn how to invest in a way that you don't have to worry about these roller coaster rides that are going on
Mhm.
in the market, feel free to reach out to us.
Yeah. So I hope you appreciate this, and thank you guys.